This is, as I said, this is just what we learned in section 1 when we were handling company accounts. But now you need to present it in another way according to the standard. So the first one, let's start with this one. We look at the format, so I can say XYZ Limited. I will be explaining the context of this, the content as I do the format. So we have XYZ Limited statement of comprehensive income for the year ended that. So the first item as a user I want to see is we can use the term revenue. I want to see the term revenue. You can use sales, revenue, income, depending on what you are given. But generally, these names, they always look the same, but you know we cannot use them alternatively. We know when to use income, when to use the revenue, when to use sales in the actual setup of business. But for the purposes of exam, the names might alternate. Then I only want to see less cost of sales. Initially, what were we doing here? We were summarizing opening stock, closing stock, can you remember? Purchases and all those things. For here now, all those workings should be done under your workings. And you ensure that you give out your workings very well, because the examiner wants to see where you've gotten your figures from. So it means the calculations of the gross profit, do it in your workings. Don't bring it to here. Your work should be as clean as possible. Okay? Then we add other income. And I'm going to explain the difference between this other income and other comprehensive income, when we'll be doing another topic again called financial assets. But the first one we have is investment income. Investment income. You can also have rental income, just for illustration purposes. Income, rental income. Then we can have another one here, gain on financial assets. I know we've not done financial assets. Assets measured at FA, fair value. Measured at fair value. We always say that in published, don't get creative in published accounts, because the format is already predetermined. Don't start getting creative here. So the other one, we have expenses. Now, when you come to expenses, according to how the examiner has set it, but I'm going to look at any expense that the examiner can have. I don't want to see things like depreciation, rental, hizo achana nazo. You need to group them into these items. For example, I will have administrative expense. So you can do your workings and you can see it is one column. You can do your workings, then tell me this is your administrative expense. Give me the figure here. So we can also have operational expense or cost, whichever. You can have it there. You can also have finance cost. So I don't want to see anything that you call finance cost includes what? Bank charges, interest on loan. I don't want to see anything here called interest on loan. The name is going to change to finance cost. Is there any other cost? Maybe we can have, I know operational is already covering marketing and things to do with what? things to do with sales and marketing, it can fall up under operational expenses. Okay. Then after that is when now we will have, that is when now we'll have before profit before tax. Profit before tax. So from the profit before tax is where now we can have less tax expense. Now, this tax expense, it will be affected by what? You need to understand how to do something called what? Deferred tax, because it is going to affect something here. You need to understand deferred tax. That's why we did deferred tax before we do this. But we are going to look at questions and we are going to refer to revise some aspects of deferred tax. So that's when we'll have profit after tax. Or rather, sometimes we call it profit for the year. Sometimes we can call it profit for the year or profit before after tax. Now, after this, we'll add something new that was not there. We always say we'll add something called other comprehensive income. In a simple term, that I always use for you to understand, these are incomes zenye hatujaona hiyo pesa. Tunajua hiyo pesa ina exist, yani tumegain lakini hatujaona pesa. In financial management, if you are to do financial management, these are the income tunaziita capital gain in nature. You have not, for example, your shares have increased in another company, which maybe is a financial asset. You can remember we talked about 0 to 50 to 20 in terms of shares, 20 to 50, and then we talk about 50 to 100. And we said if you own 0 to 20 shares in a company, just below 20, we call that financial assets. If you own between 20 and just below 50, we call it associate. If you own 50 and above, if you own 50%, or no, rather mko 50-50, you and the other shareholders mnaambatana. Hii inaitwaje? I remember the name. I know I didn't give it out. Inaitwaje? Kuna mko nayo hapo. Tuliandika investment in associate or joint venture. Joint venture is when you have equal number of shares. No one can make unilateral decision. Sana sana inakuanga 50-50. Ama hata kama mko wanne ni 25-25-25-25. That is called joint venture, where no one can make unilateral decision. You have to inform the other person. So anyway, we have 50 to 100. This is what we call what? 50. I always say 51, 51 to 100. This is what we call group accounting. Now, for me, I still want to explain to you this. Financial assets, I know I've not given it out, and I think for the question we are going to do, it will be there. But I want you to understand it in the easiest way possible. You have shares in another company, less than 20%. What is your expectations with those shares? Why are you investing in that company? You only have two reasons. Reason number one, to get a profit. Sawa. Reason number two, you want to hold it till further notice. So you want to earn dividends till maturity. So based on those two reasons, it will tell me how I'm going to handle it. How we separate the asset is why are you holding the asset. You can hold it then for a short term or for a long term. Na tunajua short term nimenunua tu ndio niuze. Lakini long term ninanunua ndio ni create wealth. In future, I want to be one of the owners of this company. So if I hold it for long term, then the accounting is different like if I hold it for short term. So let's assume I am holding it for short term. It means that I can dispose it anytime. And that's why its income, the changes, and even if it goes to the next year, the changes will be recorded in other income. Why? Because assume we have this guy called assume you have shares and the changes in that shares, you bought the shares at 40, it is now at 70 at the end of the year. Silikumaanisha the next day you can sell it. So it is as good for you to recognize the 30 as an income that is just in waiting. I've already earned it. Sawa. But if you're intending to hold this item for the next 10 years, you cannot recognize it here. You will not recognize it here. Because why? Number one, I am handling it as an uncurrent asset. But the other one, which I am holding it for the purposes of selling, I am handling it as a current asset. So the changes can be recognized, can be included in the profit after tax. But these changes of the items I'm holding for a very long time, I cannot include it here because I'm going to mislead the user. Some of those changes are gain on revaluation of PPE, either a gain or a loss. Sawa. Acha niandike gain on revaluation. If it's a gain, it's positive. If it's a loss, it's negative. So gain loss on revaluation of PPE. Hiyo tunajua how to do revaluation. We know revaluation is where you change we compare the fair value of the asset versus the carrying amount of the PPE. That gain, you cannot recognize that profit immediately. So because you cannot recognize that profit immediately, you are going to just analyze it under other comprehensive income. Then now we come back and say, what about this what? There's another one here called gain or loss in foreign exchange. Gain or loss in foreign exchange. Then we have another one here called gain or loss in financial assets held sale. And this is what we call total comprehensive income. Total comprehensive income. So, hapa sana sana, there are some items that you indicate there that the changes, sana sana tunaangalia PPE, changes in PPE. If there's any changes in the value of PPE, we take it there. I know we've not also indicated foreign exchange. We'll do it, as I said, I will do most of the notes, like for this foreign exchange, I will do it as an additional information in your books. So this is the additional information that you got to andike summary, now to explain everything that happens there. But I hope you've understood that you can have two assets, same asset, but the reason for holding the asset is what is going to separate you from putting the gain here or here. So the reason for holding the asset is very important when analyzing. So this is the format of statement of comprehensive income. Kama uko na swali unauliza. We look at another one again. So now we can look at the next one, format for statement of financial position. XYZ Limited, statement of financial position. Then you have assets. The format is very important. Non-current assets. Then we have non-current assets. So initially, what did you use to do here? Kwa tunaandika kila kitu iko kwa hii dunia eh? Hapa the only thing I want to see is the term property, plant and equipment. PPE. Hata ukienda uandike in short PPE, no one has the problem. And I only want to see the net book value of it. Sawa? Only the net. Hizo workings, and ufanye workings huko mbali. Usikuje kuchafua hii kitu hapa. Ikuwe tu safi alafu tuletee workings. The other thing I want to see is intangible assets. Intangible assets. If there is any intangible assets. Just for the purposes of format, we can also have financial assets. Financial assets available for sale. Financial assets available for sale. Then here we can have current assets. Of course, we are always using solvency. It's very important for you to use solvency. Usiandike vile tunaandika saa zingine unajipata umeandika bank hapa mbele. You need to use solvency. And how does solvency go? Inaanza na nini? Inventory. Accounts receivable. We have financial assets. These are the assets that are held at fair value. Sometimes we say through P&L. When you hear fair value, it's through P&L. Then we have bank. We can have another one here. We can have prepaid expenses. Prepaid expenses. So don't crowd it here. If you have prepaid expenses, go do the workings, only bring the word prepaid expenses here. I know initially you are doing prepaid electricity, prepaid hiyo zote unafanyia huko. Nataka tu kuona the term prepaid expenses. Then we have bank, cash at hand, and also cash at bank. Let me just say cash and bank, depending on how the equation is structured. This is what we call total assets. I know we have two formats where we can also calculate the net assets. It's allowed. You can use either this one or you calculate the net assets. Unajua hapa tunaweza enda net assets. You can simply say less current liabilities. That is also allowed. But for the purpose of today, let's just use the common one yenye tunaendanga equity. Ama which one have you used to? Sinia kwenda equity mara moja. Yeah. So we just use that one, equity and liabilities. Start with equity. Now, the workings of this equity, we'll have already done it in the statement of changes in equity. But of course, I want to see ordinary shares. The next thing I want to see is, I also want to see if there is any preference shares, it's fine, but we can have share premium. Can have revaluation reserve. Can have revenue reserve, ama retained earnings. Don't think if I'm missing anything out. and then general reserves. Twice. Yes. Even lease is supposed to appear twice. Even lease is supposed to appear twice. Can you explain how? Do it in a question, but let's say this. We did deferred tax. We know what deferred tax is. These are the easiest term is this. We have allocated the money to pay, but KRA is telling us pay in future, not now. But you see, once you allocate it in your books that you want to pay, as an accountant, when ukifutafuta, so utaiacha tu hapo. So it means it will appear as a liability because you've not paid for it. The day you pay for it is when now you're going, because when you pay, what do? You debit the liability, or rather the expense, you credit bank, right? But now you are planning to pay 1,000 shillings. And then KRA tells you, no, don't pay me the whole 1,000. Pay me 400. Then I think I can use here. Let me use here, explain deferred tax in the easiest term possible. We're going to look at how you got your 1,000, okay? But for now, you are planning to pay 1,000 shillings. 1,000 shillings. KRA tells you, no, for me, I only want, according to the calculations that we've done with you, just pay me 400 shillings. Then the other 600, I want you to pay me the other 600. This is here 0, 1, 2, 3. You are planning to pay 400 hapa, si ndio? You've already budgeted for it, you want to pay 400. You only want to pay 1,000. But KRA tells you, no. What I want you to do, pay me 400, pay me 200, then pay me the balance, which is 400 here. Let's put this one as 300 so that these are the ones still giving me what okay. 300, 200, and this one pay me 400. Let's say 100 and here 500 so that you can have different figures. KRA is telling you, don't pay me this money at once. Pay me 400, 100, and 500. So over 3 years, pay me that 1,000 euro. You cannot remove it in your books of accounts. So what do? The first transaction is which one? As at year zero, you're going to debit as an accountant. You're going to say, I'm going to debit tax expense of 1,000, and I'm going to credit tax liability, tax payable of 1,000. Sasa halafu unaenda kwa KRA, nataka kukulipa 1,000. KRA wakwambia hapana, don't pay me the 1,000. What you're supposed to pay me is simply pay me the 400. Now we are talking from this angle, maybe tuliallocate hapa, no sorry, this is a transaction for here, because you can only calculate the tax from your profit. Sawa. So this one was done here, and this one here, and this one here. So at this point, you did this transaction. Then you go to KRA for the period of this one. KRA tells you what you should do to me, only pay me tax, because now you have to remove it from here. You've already recognized it in the P&L as at that time. So these guys will tell you, just give me tax from your tax payable, just pay me 400. Then you're going to credit bank 400. What is going to happen is that you'll have 600 as your liability. Because it is appearing on the liability section, that 600 is called what? Deferred tax liability. Now, out of the 600, 100 is payable within the next 1 year. 500 is payable for a period of 1 year. And we know if something is payable for a period less than 1 year, what do we call it? Current liability. If it is more than 1 year, this will be non-current liability. That's why we have same one word, two names. So we have to separate it. Sawa sawa? Yes. Ina make sense. That is how tunajipata kwa hii situation ya deferred tax. Najua utajiuliza how do we come up with the 1000? I think the question that we're going to do, I think iko na hiyo portion. Let's look at December 2021. I think question 5. December 2021. Question 5. This question is for the purposes of understanding the format. That's the objective of today. Just to understand the format, because if you understand the format, even if you don't know anything in the exam room, uko sure unaweza toka na kitu. Ili usipoelewa format, hapo kitaumana mbaya sana. So the objective is just for you to for the format to sink in. I want to read. The following trial balance was extracted from Bawabu Limited. Ordinary share capital is 10 shillings at 10 shillings per share. We have share premium, we have retained earnings. As at the beginning of the year, we have property. We say that when you're first approaching a question, what do? You check the required. Required wanataka statement of profit or loss for the year ended 31st March. When you're checking the required, you also check which year is it ending. You get your accounting period. You can see our accounting period is from 1st April 2020 to 31st March 2021. So they want financial position and profit or loss account. So now we can go through it. Ordinary share premium, retained earnings, property at cost, plant and equipment at cost, accumulated depreciation as at 1st April 2020. We have for plant and also for buildings. Okay. I forgot. There was someone who was supposed to be online. 2 students. Nakumbuka. Hawa watatumiwa link. Mali nimefika. Sasa mali nimefika na nimefuta hapa mara mbili, watashika nini hapa? Hadi mali nimefika. Sawa tu. Hiyo tukisha katakata tutawapatia yenye na make sense kwao. I forgot to add them. Kwa wapi? Trade receivables, Trade payables, bank overdraft. You can see deferred tax, trade payables, current tax. There's another term there coming in, current tax, and that's why deferred tax is very important in this topic. Kama hukusoma deferred tax, kuja maneno. We have cost of sales, distribution cost, administrative cost. You can see they are now giving us how the costs are separated. We have dividends paid and bank interest. Hata kabla nifikiria, si bank interest inahusiana na nini? Finance cost. So even if I'm not given finance cost in my schedule, I already know we are supposed to have what? Finance cost. Let's look at additional information. Now, additional information, I always say this is topic 1 and 2. Assets and liabilities. So for you to go to additional information, you must be very good in assets and liabilities. And as I said, if you know the format, take this thing kwa trial balance venye iko, ingiza kwa format. Kumaanisha there is a 50-50 chance you are going to get between 38 and 42. Hata si 50-50. Max unaenda kupata hapo ni around 38%, 42. Ukichukua tu ingiza hapo kulingana na format. Hawezi potea sana. But it is always good for you to understand how to adjust the financial information. The worst part is that 42% cannot make you pass to the next section. You're still going to fail, irrespective. Lakini it is always good for you to understand how to do additional information, especially the free marks. Additional information number 1. On 1st April 2020, with that statement, it means it was at the beginning of the year. The directors of Bawabu resolved that the financial statement will show an improved position if property was revalued to market values. That's revaluation. I know revaluation is a comparison between the fair value and the carrying amount of the asset as at the date of revaluation. As at that date, an independent valuer valued land at 160 and the building was valued at 485 million. The remaining life of the building as at that date was 25 years. Bawabu Limited did not make a transfer to retain earnings for excess depreciation. Ignore deferred tax on revaluation. Si mnaweza ngoja ni confirm if the students are waiting, na simu yangu ikioko sana. Confirm. Tumesema the main objective of this thing is for you to present it to the shareholders. Sawa. Na umeona additional information, hata hiyo number 1, it has a lot of things, a lot of subtopics in it. So tutaenda kuhandle hizo subtopics in topic 1, assets and liabilities. Na tumeona kwa number 1 is that if I just proceed, unaona umetuambia the remaining life of the building as at the date was 25 years. Bawabu does not make a transfer of retained earnings for excess depreciation. Ignore deferred tax on revaluation. We are going to do it as the question requires. And what if the question was silent on ignore deferred tax? That's another thing we are going to ask ourselves. And I think you can remember the format of deferred tax. And there was some gain on revaluation that you were taxing on that day. Number 2, plant and equipment is depreciated at a rate of 15% per annum using reducing balance method. All depreciation, where is it charged? It's charged to cost of sales. But none has yet been charged to any NCA for the year. It means the depreciation we're supposed to take where? Cost of sales. One of the examiner is very specific. It means to calculate depreciation, we'll take it to the cost of sales. We are not going to take it to kind of for expenses. No. They add kwa cost of sales. The other thing is that Bawabu Limited estimates that an income tax provision of 113 million is required to be for the year end 31st March 2021. The balance on the current tax neutral balance represents an over or under provision of tax liability for the year. We wrote some notes on over and under provision, but because I know you can remember very well, I'll simply remind you kidogo tu, unajua hata nyinyi pia mnakumbuka ama namna gani? Yes. Then the tax base of Bawabu Limited net asset is 292 million less the carrying amount. The income tax rate for Bawabu is 30%. Bawabu Limited made a 1 shilling bonus issue on 31st March 2021, which had not yet been recorded in the accounts. The company intends to utilize the share premium as far as possible in providing the bonus issue. So we've said we are doing December 2021, question 5. Question 5 inaitwa Bawabu Limited. Bawabu Limited. Aya. We start with note number 1. We said revaluation, si ndio? Note number 1 is revaluation. We know revaluation is the difference between the fair value. It has to be done by a professional valuer. Then it is the difference between the fair value versus the carrying amount of that non-current asset. Tuko pamoja hapo? Tuandike revaluation because I know maybe revaluation is a difference. Revaluation is a difference between the carrying amount Revaluation is the difference between the carrying amount of an asset, of an NCA, the carrying amount of an NCA, of an current asset, and its fair value, and its fair value, and its fair value. It is simply that change. To record this change, we assume it is a gain, sawa? If it is a loss, ni vice versa. Debit revaluation, debit PPE, credit revaluation with the increase. We also know one thing, that depreciation is always done at the end of the year. Sio tunajua? So the first thing we ask ourselves when you are doing this revaluation, when is the revaluation taking place? At the beginning of the year. It is taking place on 1st April 2020. So we ask ourselves, what was the carrying amount? Because here we have to compare the CA versus the fair value. The CA versus the fair value. We are told that for it to show a good one, the independent valuer valued land at 160 and building at that. So let's first of all, we ask ourselves, what was the fair value? The fair value, we know land was how much? Land was revalued at 160 million, and then we have buildings was revalued at 485 million. So then we'll ask ourselves, what was the value of land and building as at the same date? So we are told that land, let's first analyze land. The carrying amount of land was how much? Look at your trial balance under property at cost. We are told land was 146. Okay? Can you see that? 146 million. It is now moving from 146 to a new value of 160 million. And we know land is not depreciated. So that is the same carrying amount. That cost of land is the same carrying amount as at that date. So what was the increase? You can see this is an increase. It is increasing from 146 to 160. How much is that? 14. It is increasing. It is an increase in that. Let us also analyze. So with this one, what are you supposed to do? You are supposed to debit PPE an amount of ama hata niseme land ndio tusiende kwa PPE, to assume land 14 million, then you credit what? Revaluation an amount of 14 million as at the date of revaluation. You do that as at the date of revaluation. So after doing that, we move now to the second one. We ask ourselves, what was the carrying amount of buildings? Carrying amount, I think this is working one, so that we can always follow it in our name. Carrying amount of buildings. What is the carrying amount of buildings? The carrying amount of buildings, we know, the carrying amount is for buildings, we know it is a net book value, okay? So, and we know net book value is equals to cost minus accumulated depreciation. And you ask ourselves, what was the cost as at 1st April 2020? The cost was simply 427 minus 146. How much is that? So number that the property is 427. Inakuwa ngapi? 281, eh? So this is 281 minus accumulated depreciation. What is our accumulated depreciation as of that date? It is 122. It is in the trial balance as accumulated depreciation for buildings 122. That will give us a net book value of 159 million. Okay. So the carrying amount was 159. So we are revaluing it. So revaluation is taking place from 159 million to how much? 485. We now want to take the carrying amount from 159 to 485. 159 to 485. That will give you how much? Less. Yes, what is the difference? Because it is moving from 159 to 485. It is increasing by how much? Sinaka increase? Yeah. Yes, by how much? 326 million. Then we write something for us to understand what it just said. 326 million. You see, the new value, it means then the new value for land is how much? Is 160. So, and the new value for buildings is how much? Is 485. In short, if I was to do the one for buildings, ningesema debit with the increase. We are supposed to debit buildings by 326 million and we credit revaluation by 326 million. Tuko chonjo hapo? Kuna mtu amepotea ama si wote tuko salama? Yes. No, it's not supposed to be 427. It is 732. Ndio? 732. Nani alinipatia 427 huyo ametumislead? Ni ngapi? 427 is for plant and equipment. So how much is this one? This will change. Inakuwa ngapi? 586. So what is the new 586 minus 122? 464. It means we are moving from 464 to 485. That will give us 21. Yeah. It is increasing. It means then that building is being valued by the new value for land remains to be 485. And then now the buildings, we are going to debit buildings by 21 million and credit revaluation 21 million. So let us look at our depreciation now. Let us now look at the depreciation. We are told in note number, we just do it once and for all. We are told that because we want to get the net book value of our PPE. Our land has got no depreciation. So the net, or we can call it PPE at net book value. Let me do it here for the purpose of continuity. PPE, we want the net book value of our PPE. So the first item is which one? Land. Our land is how much? As at the beginning of the year, what is the value of our land now? Our land is 160 million because now we have moved it from the 146 to 160. That is 160 is the new value of our land. So it means there is no, we always say cost minus accumulated depreciation. So our land will always remain to be 160 because land does not have depreciation. We move to buildings. We move to buildings. Our buildings at the beginning of the year is how much? 480, 485. Our building is 485. And we are told that this building, we assume there is no accumulated depreciation because that is the new value. Sawa. That is the new value. So there is no accumulated depreciation. And we are told that this building, we want to stay with it for the next 25 years. We want to stay with it for the next 25 years. So the depreciation is 485. Depreciation for 1 year is 485 divided by 25. See, that is the depreciation for 1 year. Because we want to stay with it for 4 years. Hiyo tumeelewana? Ama nifanye depreciation kando? We know you can recall from our previous lesson is that depreciation, when you are told in terms of number of years, is cost minus salvage value divided by number of years. And our cost for this situation is 485 and then 485 million. Salvage value is 0 and the number of years is 25. It means the depreciation per year is how much? 19.4 million. So that is the depreciation. It means then what is our net book value? What is our net book value? Hmm? 465.6 million. 465.6 million. Then we have another item called property and equipment. Property. The other term that they have used there of issue of some will not be transferred to excess depreciation. They say they do not make transfer of retained earnings from excess depreciation. I'm going to handle that when we'll be looking at deferred tax. And again, they have said ignore deferred tax in this situation. So we'll again ask ourselves for now, then what is our item of plant and equipment? What was our cost? The cost of plant is 427. What is the depreciation of the plant? We are told plant depreciated at 15% using reducing balance. That's what we are told. Okay? Then if that was our cost, what was our net book value? The net book value, we know when we talk about reducing balance represents what? When you are calculating depreciation can be calculated either by straight line method or by reducing balance. And when you hear reducing balance, is that the percentage of the depreciation is applied on the net book value. Sawa. So if I'm just to do here depreciation of plant for the purposes of your revision, we say plant is depreciated using reducing balance. It is depreciated using reducing balance. And we know then if it is reducing balance, the percentage is applied on net book value. The percentage is applied on net book value. So we'll ask ourselves, what is the net book value as at the end of the year of the plant? The net book value then, and we know net book value is equals to cost minus accumulated depreciation. and our cost of and the cost is 427,000. Okay, I'm doing this so that you can understand where we are coming with this one. I know in an exam situation we are going to use tutatumia tu hii mara moja, but for now, for the purposes of you also to jumpstart your brain, I'm going to use this. And I'll ask myself, what is accumulated depreciation of the plant and equipment? It is 85,400. Okay, that will give us how much? 341,600. That is the net book value. And we are told we are supposed to apply 15% on this value. So we'll say 15% of how much? 341,600. Itakupea ngapi? 51,240. 51,240. So basically, the net book value of the plant will be 3. Hmm? Mm. 962. I hope you're getting the same answers, all of us. So let's look at the second one. Bawabu Limited, note number 3. Bawabu Limited estimates that the income tax provision will be 113 million. 0.8 is required for the year ended at 1st March 2021. The balance in the current tax, in the trial balance represent an under or over provision of the tax liability for the year ended that amount. As at 31st March 2021, the tax base of Bawabu was that above the carrying amount of the asset. Now, there are two items here. There is deferred tax and there is current tax on the credit side. I want to give you the scenario first of all. What is current tax, or rather what is under provision? Or first we write, basically, there are two main differences. There is a provision and there is deferred tax. Provision, okay, let me put it in a language maybe mtaelewa. There is something called installment tax. Is where installment tax is where you see under deferred tax there is nothing you are paying. You are simply allocating. Ndio? But installment tax tuseme umekaa chini ukaona naenda kulipa 100 million. Kulingana na biashara niko nazo, naenda kulipa tax ya 100 million. Ukalipa 100. What will you debit? You're going to debit bank and credit tax liability, sindio? And actually, you're going to credit current tax. You're going to say this is part of the current tax that I'm going to pay. Then at the end of the year, you find yourself that KRA tells you that you are only supposed to pay 80. You see, what you did is that you over-provided. You budgeted for more, but you have already paid for more. Sawa sawa. It means umelipa in advance tax. Si tunaona hiyo kitu venye inaenda. So it means it will still appear as a liability in a statement of financial position as 20. Sana sana, that is the closest I can come to defining to you what is over provision or under provision. Why do we have that negative there? Sawa. So hiyo 20 ingine tulikuwa tumewalipa, wataipeleka to the next year. Mbona venye inafanya kazi? And then someone might ask me, oh, na sasa si tulilipa excess kumaanisha KRA wako na pesa yetu. Tusifikirie in that angle. If you go to that angle, you're going to start handling it as an asset, which will not make sense, because I'll ask you, then how did you do it? Uh, let's look at it in a more easier way. You you wanted to pay KRA, how much? 100 million, eh? So, ukaenda what did you do first? You said tax ni ngapi? 100 million. Alafu, current tax, 100 million. See, that is always the first transaction that you're supposed to do. Let's assume that is the way it is. Then, now you go and pay. You've already handled this one in the P&L. So, you're going to debit current tax, 80 million, and then, no, you pay all of it. Unalipa the whole of it. Why am I saying as if now I want to start? Okay, unalipa the whole of it. So you're going to debit what? Bank, current tax, 100 million. What am I doing? Tuende kwenye swali kwanza. Acha tufanye na swali. Atuandike kitu. The income tax, let's just write something. Income tax is a tax expense for the current period. Income tax is a tax expense for the current period and is calculated as follows. We need to have, it is calculated as follows. Income tax, we have income tax. Then we say add over provision. How will I put it in another way? Niseme over provision or under provision. No. Niseme add over provision. It will add. It's supposed to be less. Less and over provision. Then you add deferred tax increase. The opposite is true. So nikisema less over provision, it means you're supposed to add under provision. Sawa. Nikisema add deferred tax increase, then it means you're supposed to less deferred tax decrease. The opposite is always true. This is what you'll have as your tax expense. So let's say, if current tax is over provided for, if current tax is over provided for, it will appear on the credit side. If current tax is over provided for, it will appear on the credit side of the trial balance, credit side of the trial balance, and vice versa. Credit side of the trial balance and vice versa. How much, if you look at our trial balance, how much was over provided for? The current tax is saying 12,800 on the credit side. So you say the 12,800 is an over provision. The 12,800 is an over provision. If you look at our question was saying that the balance, so if it is an over provision, it means then we are going to less it. Sawa, we are going to less it. It means we over provided for it. We paid we over okay. Ni tutaangalia na question. I don't want to go back there now. Tarudi eneo tutakuwa na front and back. But basically we gave it a higher provision than what was required. So we need to less it from what is here. Then we look at the second part, that the balance in the current tax in the trial balance represent as at 31st March 2021, the tax base of Bawabu net assets was 292 million less than that of the carrying amount. So we need to ask ourselves then, how do you calculate deferred tax? Deferred tax is a situation where the carrying amount, we compare the carrying amount versus the tax base. And I said this is, if you do this, if the answer is positive, it is going to lead to deferred tax liability. So this is what we call the temporary difference. And we said we always look at CA minus TB. And we are told the CA minus TB is how much? 2. Which side is higher? The carrying amount. The TB is less. Is it the carrying amount that is higher or the tax base that is higher from the statement? The tax base of Bawabu was less than the carrying amount. It means the carrying amount is higher. So the answer is positive. Sindio? The answer is positive of 292,000, and then we minus that times the tax rate of 30%. Tax rate of 30%. Sasa hapa ndio tutajua wenye wamesoma deferred tax na wenye wako wa class. Unajua nini nimefanya hapa? Let me recall to you something. We said when you're doing deferred tax, we compare the tax base versus the carrying amount. If the carrying amount is higher than the tax base, then it is going to lead to a deferred tax liability. If it is vice versa, then it is going to lead to deferred tax asset. Tumeelewana hapo? Sasa tukaambiwa that the CA is higher to TB by this amount. It means if I multiply it by 30%, it is going to lead to a liability at the end of the year. And how much is that? What is 30% of 292,000? $87,600. So after you do that now, I'll come and say, then I will open my deferred tax account. And I ask myself, what is happening with this deferred tax? We look at what was the opening balance of our deferred tax from the trial balance. Is it 97,600? So the opening balance is 97,600. If the question in topic 1 was telling us in note number 1 that you include deferred tax, or it was silent, we could have come here and said gain on revaluation. Gain on revaluation. And you know, our revaluation was how much? The gain was how much? Sini 14 plus, it is for the new buildings. You look at the item that has an item of depreciation. So tungekuja tuseme it is the, what was the gain? It is here 21 times 30%. Tungeiweka hapo. So, but for our case now, we don't have the gain. We don't have the gain because the examiner does not want us to have the gain. So here tutakuja tukasema, in all that we want our closing balance to be how much? 87,600. Tuko pamoja? We want our closing balance to be 87,600. It means then there is an increase. So you can see, is it an increase or a decrease? It is moving from 97,600 to 87. It is reducing. It is moving from 97 at the beginning of the year to 87. It means the difference always goes to P&L, an amount of 10,000. But you can see it is reducing. So this is a reduction in deferred tax. It is a reduction in deferred tax.